Marry the home and date the rate is a saying you may have heard when you were initially planning to buy a home. The idea behind this saying is that you can always refinance your mortgage to get a lower rate, but you can't go back in time to purchase your home at the once lower price. Well, the time has come for many of you to break up with that high interest rate. Brand the Mortgage Man here, and today I'm going to provide you with information necessary to make an informed decision when it comes to refinancing your mortgage. I've helped more than 10,000 home buyers over my 20+ year career, putting me in the top 1% of loan originators nationwide. But I'm not only experienced in purchase mortgages, I help many of my clients with the refinance process as well. In this video, I'll explain what a refinance is and why people go through the process, how to start the refinance process, how the interest rate you receive is determined, what both rate and term and cash out refinances are and when each makes sense, examples of how both rate and term and cash out refinances work, and I'll even share the trick I use for my clients to not restart their loan at year one. So let's get into it. So first off, what's a refinance? Well, that's pretty simple. You're getting a new mortgage to pay off your existing mortgage. Really that simple. You got a mortgage to buy your property. Now you're getting a new mortgage, and when you get that new mortgage, the old mortgage gets paid off. That's really all there is to it. But why do people refinance? Well, there's a multitude of reasons why someone would refinance. Some are looking to reduce their payments. Others want to reduce their loan term. Some want to pay off debt. Some want to pull out some funds to buy other properties, like an investment property. There are even cases, and it's common, where someone needs to pull equity out of their property if they're going through a divorce to pay their spouse off the portion that they're due. But how do you actually refinance? Well, that's really a good question. How do you refinance? Well, first off, you probably want to reach out to the lender that helped you with your purchase, right? You're watching this video, I assume, because you have a mortgage on your property and you got that mortgage from either a bank or lender or broker. So I'd start by reaching out to them and seeing if it's something they can help you out with. You're going to go through the same process you did when it came to getting the mortgage on your purchase, right? You're going to provide your income documents, your asset documents, your credit's going to get pulled. You have to prove that you're employed if that's how you earn your income. Maybe you're on a fixed income. You'll prove that you have Social Security, disability, pension, whatever it might be. But you're going to provide the same documents that were used when you bought your property, other than a purchase contract. In most cases, you're going to need an appraisal to determine what the current value of the property is. So that's a big difference. When you bought the home, you were hoping that the appraised value was at least equal to what the contract price was. But when you're refinancing, you want that value to be higher, because the higher the value, the lower the loan to value. And that's where we get into what affects the pricing or the interest rate that you receive when you refinance. So there are multiple factors, with loan to value being one of them, meaning the amount you owe or the amount you're borrowing compared to what the value of the property is. Now, keep in mind, here in Florida, the average appreciation on a home in any market is about 5% per year. Now, in a hot market, it could be even higher, right? We saw 20% plus appreciation during COVID, right? We're talking 2020, 2021, and 2022. So that was substantial. So someone that got their mortgage in 2021 that wants to now refinance for whatever reason in maybe 2024 should have a lot more equity in their property. Maybe they got an FHA mortgage when they bought. Now they have over 20% equity in their property. They want to go into a conventional mortgage, for example, and they're able to get rid of mortgage insurance. So even if the rate's going up slightly, getting rid of the mortgage insurance might still give them a lower monthly payment, which is really what it's all about if they're refinancing, looking for that lower payment, not necessarily a lower interest rate, which is what some people might think. Now, your credit is still going to be a big factor, right? If you're getting a mortgage term longer than 30 years, or longer than 15 years, you're going to have a good credit to get the best interest rate. If you don't have good credit, then don't expect to get the lowest possible interest rate when you refinance. It's no different than when you bought the property. The better your credit, the better the rate. The worse your credit, the worse your rate. That's just how it works. The loan term is going to make a difference, right? I mentioned if your term is longer than 15 years, and that's because loan level price adjusters, which is something I talk about in some of my other videos, where I talk about how the rates can vary from one lender to the next, or why one borrower can get a better interest rate than another. Well, loan level price adjusters are a big part of that, but those loan level price adjusters pretty much go away when the loan term is 15 years or less. But if you're going with a 20-year or a 30-year or anything in between, well, in those cases, your credit's going to be a big part of that, and the loan term is going to be a big part of what your rate's going to be, because the longer the term, the higher the rate's going to be. The shorter the term, the lower the rate's going to be. So there's a combination of things that are going to determine your interest rate or the pricing on those rates, meaning the cost to obtain the interest rate or discount points if you were to pay any. So let's talk about when a rate and term refinance, which is one of the types of refinances that someone will do, makes sense. So first off, a rate and term refinance is when you're going to refinance from a 30-year mortgage into another 30-year mortgage. You're going to refinance from a 30-year mortgage into a 15-year mortgage, right? Or you're looking to get a lower interest rate and lower payment, right? That's a rate and term refinance. You're not taking any money out of the property. You're trying to keep your loan balance as close to the existing loan balance as possible when you go through the process. So let me give you an example of what a rate and term refinance looks like. So let's just say that you originally had a loan balance of $500,000 on a 30-year mortgage at a 7.5% interest rate. Your principal and interest portion of your payment, and just for these examples, I'm only going to use principal and interest. I'm not factoring in mortgage insurance. I'm not factoring in property tax. Is not factoring insurance, because at the end of the day, it's really the principal and interest that we're focusing on. And in these cases, we've made the assumption that this individual has at least 20% equity, which doesn't require mortgage insurance. I know that's not going to apply to all of you, but just for these examples, that's how we've done this. So the payment at 7.5% interest on a $500,000 loan over 30 years was $3,496. That's your monthly principal and interest payment. Now, you're going to refinance. You've had the mortgage for a year or two. Your new loan balance is $490,000, right? You've paid it down over, it's not going to be by much, but let's say over 2 years, you've paid it down by roughly $10,000. So you're borrowing $490,000. Your new mortgage term is going to go with another 30-year mortgage, but the rate's 5.75%, not 7.5%. Your principal and interest payment at 5.75 on the slightly lower balance is $2,860. So in this example, the monthly savings are $636, which is $228,920 over 30 years. So even if the closing costs are $9,000, which you will have closing costs when you refinance most of the time, the net savings would still be almost $220,000. Now, let's compare that to a cash out refinance, right? Which is another type of refinance someone would do. And a cash out refinance means you're borrowing more than the original balance, and you're either going to receive cash in your hand from the equity in your property, or maybe you're going to pay off some debts with the refinance. That's considered a cash out refinance as well. Now, why would someone choose to do this? Well, maybe they have a lot of equity in their property and they want to use it for other things, right? I mentioned earlier, some people refinance because they want to buy an investment property. Some want to pay debt off, right? You just want to have cash to maybe invest, right? There's a multitude of reasons why someone would do a cash out refinance, right? You can't use the equity in your property if it's stuck in your property. So you either have to sell or refinance to access it. So keep that in mind. Now, when it comes to cash out refinances, one big thing is that you need to have a minimum of 20% equity in your property to even be considered to do a cash out refinance, right? Which is different than a rate and term refinance, where you can have 5% equity and still do a rate and term refinance. So keep that in mind. Now, let's go over an example of a cash out refinance. So let's use the same scenario as before, a $500,000 original loan balance over 30 years at a 7.5% interest rate, same principal and interest payment we talked about earlier, $3,496. But in this case, let's just say you have existing debt outside of the mortgage of $50,000, right? Credit cards, high interest loans, whatever it may be. And the existing payments on those $50,000 in debt are $1,000 a month. When you're looking at the benefit of a cash out refinance, you need to look at your total monthly expenditure on your mortgage payment and those debts that are going to be paid off, right? So in this case, we're talking $4,496, which is the $3,496 principal and interest payment on the mortgage, plus the $1,000 in payments on the $50,000 in other debt that probably has much higher interest rates, right? Credit cards, 22%, 23%, whatever it might be, versus a mortgage. Now, let's compare that to a new mortgage. So the new loan balance in this case, we'll say is $540,000, right? We're saying that's your $490,000 loan balance after a couple of years of having a loan, plus the $50,000 in other debt that's being paid off. The new mortgage terms, we'll say, are a 30-year at a 6.25% interest rate. Now, the interest rates on a cash out refinance are higher than that of a rate and term, which is why I'm using a 6.25 in this example versus the 5.75 we use on a rate and term refinance. So keep that in mind. The principal and interest payment on this new loan amount is $3,325. Now, that's still pretty close to what you were paying on the mortgage before, but keep in mind we're paying off a bunch of other debt that equals $1,000 a month. In this example, the monthly savings are $1,175. So you're not just going to compare principal and interest to principal and interest when you're paying off other debts. You need to look at all of your monthly expenses that are being paid off and compare to that. So in this case, you're saving over $1,000, almost $1,200 on your monthly expenses, which is substantial. Think about what a difference that could be. It's such a burden lifted off your shoulders to be able to get rid of that debt if you have it. And that's something that's common for a lot of people, especially right now. Credit card usage is at an all-time high. So a lot of those people with credit cards also own homes that have equity in them. So this is something that should be considered for those individuals. Now, I mentioned I'm going to give you a trick that I use for a lot of my buyers, or a lot of my clients, I'm sorry, so that they're not having to start their mortgage over at year one. And what I mean by that is, in these examples, we talked about someone getting a 30-year mortgage or having a 30-year mortgage, being 2 years into that, and then starting over at year one of a 30-year mortgage. So technically, they're tacking 2 years on to the amount of time it's going to take to pay their home off, right? Because they were already paid for 2 years. Well, what if someone doesn't want to have to add years onto their loan? Well, you can actually have a custom loan term, meaning you may have heard of 30-year mortgages or 25 or 20 or 15-year mortgages, but did you know you can get a 29-year mortgage or a 28-year or a 27 or 26-year mortgage? We offer custom loan terms in order to best suit our clients' needs. So let me give you an example of what this looks like. So let's use the same information we were using before as far as the original loan balance being $500,000 is a 30-year mortgage at 7.5% interest, and your principal and interest payment is $3,496. But let's just say you had that mortgage for 3 years. So let's compare this to getting a new mortgage for $485,000, but instead of having it over 30 years, right? Instead of starting over at year one is what I'm saying and what I mean, you're gonna get a new mortgage for 27 years. So let's say a 27-year fixed rate mortgage is 5.75. And if you're getting a loan between 26 and 29 years, you're gonna get the same interest rate that you get on a 30-year mortgage. So keep that in mind. So your new mortgage is a 27-year mortgage, right? You're not adding onto it at all at 5.75, so lower interest rate. Principal and interest payment would be $2,951. So in this example, the monthly savings are $545. They're still substantial, which is $176,580 over 27 years. So even if the closing costs are $9,000, like we talked about initially, the net savings would still be almost $168,000, right? So keep that in mind if you're concerned about refinancing and having to start all over at year one, right? That's a common concern for people, and you do not have to do that. So make sure you ask your lender about a custom loan term. Keep in mind that there's no limit to the number of times you can refinance your mortgage. The amount of time you plan to keep your mortgage or stay in the home is a key factor in deciding whether or not now is the time to refinance or not. So make sure you fully understand your short and long-term plans before making the decision. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left in my videos.